Thanks indeed. Let's welcome in Sandeep J Shah. He's managing partner at Motilal Oswal Private Wealth Management. Sandeep, great to have you back on the show. Appreciate your time. Prashant this side. You basically are cautious, but you're saying stay invested. But fresh allocation into equities, perhaps wait a little bit, Sandeep. Is that the approach?
Well, just to put it in context, even in July this year, I had maintained that this was just what had happened was just a bull market correction. So I'm obviously delighted to see the market hitting new highs. And I have actually been continuously using this playbook of 2003, 2008, where we had seen 30% corrections and the market went on to make a new high. That's exactly what's happening now. And in the context that, unfortunately, of course, valuations are not as cheap as they were, obviously, in July, though valuations are still perhaps cheaper than they were saying October 21. It's not the time to go overweight on equities. At the same point of time, I think it's important to stay invested because the longer-term bull market is still in place. And I think for fresh allocations, I think you've got to stagger your approach, but stick to your asset allocation or buy the dips. If you look at, market cap to GDP is about 110%. That's below the peak of 140%. Of course, we're seeing far larger companies getting listed now. If you look at it on a trailing P and a price to book basis, we're about 10% higher than the long-term average. If you look at the 12-month forward P, and we've actually upgraded estimates post last earnings quarter results, 12-month forward P is about 6% higher. So that's not significantly expensive, but it's at the same point of time, not the time that you actually go overweight on equities. So, longer term, we're still, of course, still on track to become a $5 trillion economy by, say, 2027. Exports are expected to go threefold by the end of this decade. Share of exports should double to 4.5%. And, the capex cycle seems to have begun. So you're seeing capital express both on the public side, on the private side, as well as households, of course, more of real estate. So it looks like we're definitely, the new business cycle has improved. Credit growth at a multi-year high, 17%. So we are seeing revival in real estate. It's a very important sector. And auto, which had again gone through long periods of slump. So you should see a lot of trickle-down effect as well from all of this in building materials and all of that, consumer discretionary. And, corporate balance sheets remain clean and robust, and banking should actually is well capitalized to actually help India grow as well.
Sandeep, afternoon. So what you're saying is that it's a good idea for you to continue with your SIPs. But most of us have a fixed SIP, right? We can't incrementally allocate more money. So within the money that I have, which is being allocated to SIPs right now, what is the best mix? How much should go to your blue chip funds? Should I increase my allocation now to small caps and mid caps because that's where perhaps the alpha could be generated? Should I be allocating incremental amount for IT now, which I haven't been so far, perhaps over the last 12 months, given its underperformance? Just tell us, what's the best way to construct your SIP now?
Yeah, that's a good question. I think that, if you were to look at, it also, of course, has to depend on your risk appetite in the sense that more importantly, your ability to handle volatility, right? I think that is a very important thing. But keeping that in perspective, I think both large caps and small caps are looking more attractive than mid caps. And the small cap index is still about 18-20% below its high. So in that sense, it would appear that there could be some room there. But I mean, of course, it's very important to remember that small caps will always be more volatile. And the first sign of a correction, they will correct more. But so broadly, I think I would still prefer to go in for multi-cap funds. We've seen that, over a 3-year rolling returns, if you compare multi-cap funds with large cap funds, what we've seen is typically that the drawdowns tend to be similar over 3-year rolling periods, but the upside can be much more. So for multi-cap funds and then balance it out with small cap funds if you have the appetite for that. And but yes, don't stop your systematic investments. If the market dips, then you can even add, increase the size.
Makes sense, Sandeep. Good afternoon. The domestic story is looking up in comparison to what's going on in the globe. And if that's the case, then cement consumption will go up. But you're not too bullish on cement. Give us the reason why.
Oh, I'm absolutely bullish on cement demand. No question about that. I was just talking about how the real estate sector is going to lead to, a lot of demand and all of that. Of course, so, the point is that you are going to see housing demand. There is trust on infrastructure. We should be hoping for a recovery on the rural side. However, that's only one part of the picture, right? I mean, ideally, you want to be in a sector where you have both engines firing for you, where you see demand growth and where supply is not, or not, you're not concerned that supply may be excessive. And this is the first time that we've seen a very ambitious player actually come there. And post this entry, we've already seen some of the biggies announce expansion. So while it's possible that sanity may prevail and you might not see any serious price undercutting, but investing is really about trying to find where the odds are stacked in your favor, right? It's not about, unless you're a trader. A trader could still well be nimble, and it looks like short-term cement prices may bounce back, but you may trade. But if you're an investor, you want something where the odds are significantly stacked in your favor. Or where things are very, very clear to you, and it's very easy to take an investment call, right? The best investments are usually the simplest and the easiest to figure out. And this one, unfortunately, is not so simple. So, you've really got to hope that the producers will maintain pricing discipline and they will not go in for undue capacity expansion. And that's not an easy call to make. So therefore, I'm staying out.
Sandeep,
Sandeep, you were recommending some opportunistic ideas in retail and energy. Could you elaborate a little bit more?
So, we've started seeing that in some cases, as far as retailers are concerned, we've started seeing that some of them sales have gone back beyond the pre-COVID highs. Of course, on the value side, there's still a lot of problem, right? On the value retailing side, it's still significantly below pre-COVID levels. So, as we should, as the economic growth continues to build up, I think discretionary consumption will continue to pick up. And I think to that extent, I think there is a fair amount of possibility there. On the energy side, of course, you have to be a little more selective. And here I'm talking more about green energy and looking for good ways to play that and ancillary ways to play that. So, and in case where you find that, some of the existing power producers have a very strong green play, which is not fully factored in. I think that's the kind of play. So I'm not really suggesting that you go in for the conventional energy plays here, but it's really about, and India is clearly making the transition to green energy. And so looking for plays actually to participate in that.
Sandeep, IT services, I mean, what's the view, and you think makes sense to buy a IT fund, a tech fund?
Oh, certainly. I think that as far as tech is concerned, while we are obviously, some of the companies have spoken about some slowdown in specific pockets. But if you were to look beyond that, I mean, if you were to see that their order books are still quite good, you should see significant, margins should bounce back pretty strongly, because a lot of the freshers they've hired will become productive. A lot of their subcontracting costs should come off. I think as of now, demand is still reasonably good. It's of course tapered off a little, but valuations are still very reasonable. They generate huge amount of cash. You have a lot of very good quality companies with great corporate governance. You have return cash flow comparable to some very good consumer companies, but valuations, of course, significantly lower. So yes, absolutely. I think tech is something that I think you should have in your portfolio.
Sandeep, what about insurance companies? And particularly if you have a view on LIC, a lot of fanfare, a lot of, weight was there when it was coming to the markets. It came, and it wasn't a very pleasant surprise, actually, for a lot of those who got those shares. But now it seems there's a bit of an opportunity ahead. Your take on it at current valuations?
So insurance, has been looking like, a great sector to be in for a while now, right? There's a huge amount of under-penetration and financialization of savings and all of that. And we have some very good companies there as well. Unfortunately, there's always been some factors which have actually come in the way of actually significant growth. You would have thought that COVID would have led to a lot of people going ahead and actually wanting to insure themselves, especially their lives. But we discovered that growth didn't happen then because, insurance is a product that needs to be sold. You need a lot of counseling there and advice in terms of selling it. So a longer term, of course, remain positive on insurance. It will be difficult not to be bullish on India and India's financial sector and not be bullish on insurance. But, it's not been such a clean and clear story. So look for corrections, look for dips there, look to buy the leaders there. I think the market, for some of the newly listed PSUs, I think the market wants to see demonstration of performance and see that, that they're able to at least regain some market share and see some clawback to profitability. Some of these PSU insurance have had very high participating policies which have affected their embedded value. So a lot of promises have been made about transition in their business model. So I think investors want to see that come through before they actually start paying significant returns. But, any company that is able to hold on to their market share, whether it's a PSU, even if it's a PSU, I think should merit attention.
All right, Sandeep, we'll leave it there. Thank you very much for your time. Great speaking with you. It's a pleasure, as always, having you with us here on CNBC TV 18. We'll take a quick break here.